DuPont analysis sounds fancy, and I know I was supposed to drop the SVL video, but because this is one of the analysis that I use in it, I think it would be a better introduction to actually making the video more understandable. Plus, I also need some real-world examples that I'm going to go out today and get for the SVL video. In addition to it, give me a little more time to finalize certain stuff so I can come to you guys correct. Come. You know what? To the intro. What's up, my little peeps, and in this video I will be explaining DuPont analysis. And according to Google, DuPont analysis is a useful technique used to decompose the different drivers of return on equity. An investor can use analysis like this to compare the operational efficiencies of two similar firms. Managers can use DuPont analysis to identify strengths or weaknesses that should be addressed in a business. So you guys know me, and I love give examples to better bring across certain concepts. As Google said, DuPont analysis breaks down the drivers of return on equity, and they break them down into three components. You have profit margin, which is calculated by net income divided by sales. You have return on asset, which is sales divided by assets, and you have leverage, which is assets divided by equity. And if we do what my stat teacher usually says, she usually says plug and chug, you'll see that by eliminating each corresponding metrics, it will come back down to net income divided by equity. And you know what those mean? Profit margin means how profitable a business is as it relates to what percentage of sales is net income. Return on asset means how much money the company generates using its assets. And leverage is how much capital is in the business that is debt compared to equity. Now, let's say you have a company with these vitals. Up to 2019, it seems like they had 2/3 of the drivers positive, meaning they were growing continuously at a larger percentage year over year. But in 2020, you see it starts to decline. And why might this be? The profit margin fell, means cost of goods are getting more expensive. Return on assets also fell, which means that a company might be becoming less efficient at its day-to-day operations, and the leverage has been growing consistently, which means it's basically funding more of its assets by issuing debts than equity. And based on these numbers, it might be unsustainable, as it might seem like a risky investment to investors. And there might be a lot of reasons why a company might start to decline. It can be inflation, so cost of goods are getting more expensive to make, which is reducing their margin. It can also be an addition to competitors coming into the market, which means that they not only lose market share, but they also have to spend more money on advertising because the competitor is going to advertise to get more of the market share, which directly affects profit margin, because if you're spending more on advertising, means you're keeping less for yourself. And that's really it. I just thought that it was a really cool concept to understand before we start understanding companies. So as usual, smash the like button for the YouTube algorithm. Definitely subscribe, tell a friend, and see you Monday.